Yahoo Finance's interactive wizard, Jared Blikre, is here. So, Jared, why should investors be hopeful this month?
Thank you, Rochelle. Interactive wizard, I will take that. First, let's start off with what's been happening on the economic calendar going back year to date or a year. This shows this is a city economic surprise index, and not surprisingly, when it's going higher, that means that economic data is coming in more surprising, or at least in a favorable way, than unfavorable. And when it's going down, that means we're getting some negative surprises. What I want to show here is that we are off the highs that we got in July of this year, and we have inflected a little bit off of these lows. And in fact, if I take a look at a chart of the S&P 500, we're going to see a similar story where we are off of the highs, but we have inflected off of these lows. And in fact, last Friday was a better than expected payrolls report. So we saw that inflection up, not only in stocks, but also that city economic surprise. But let me show you what's happened historically. Now, I'm going to show you going back about 20 years. This indicator is mean reverting, as you might expect. When it gets too high, where there's probably a little bit more favoritism or favorable expectations built into the market, and then it rolls over. And when it gets too low, well, that's extreme pessimism, and that's going to inflect up. Now, this doesn't track the stock market exactly. We don't necessarily have to see both of them going up, but back to the year chart here, you can see if we were to inflect up here, that would mean that the economic data is coming in better than expected. And in fact, even if we were to go down, we might have a market that is going up on bad news. Sometimes that happens as well. But why would that happen? Well, you have to think, are we in line for a recession? And does the economic data coming out, does that suggest that we are entering a recession? There are very different results from the time that the Fed enacts their first rate cut, whether or not we are in a recession or actually develop into a recession versus those that don't. So if you take a look at the global financial crisis and the dot-com crisis, when the Fed started cutting rates, even though that was cutting rates, that was a bad time to enter the stock market because a recession developed and we had a long, protracted bear market from there. If you take a year like 1998, when we avoided recession, but the Fed was actually cutting rates, well then, that was a good time to enter the market. So everything that's coming out of the market has to do with whether or not we're going to end up in recession. And unfortunately, we don't know that we are until long after the fact. That's because the National Bureau of Economic Research, they are the ones who decide whether we're not in a recession, and they do that with 20/20 hindsight. So we might even not know that for months to come. I'm going to close here. S&P performance by month of the year. September is the worst of the last 4 months of the year. This goes back to 1960. If you were invested only in September, you would have lost 40%. But as I have been showing, when we have a market that was really strong through July and just fell off in August, well, guess what? That tends to have a very strong end to the year, not only in September, but October, November, December. So point is, despite everything you've heard that September may be a terrible month for stocks, guess what? This year, it might be a little bit different.
And certainly taking a look at the VIX, that certainly seems to be the sentiment there, looking at the VIX at a 20-year low. So clearly they're seeing rosier days ahead as well. Our very own Jared Blikre, thank you so much.